it gets harder for people to actually want to rent and lease out properties, because like you're finding, Mike, the cost becomes excessive to where you're like, I'm not getting a return. I have to go to a different asset class that's not real estate.
What is going on, guys? Welcome to today's episode of the Collecting Keys Real Estate Investing Podcast. If I sound a little quiet today, I apologize. I'm sitting in a co-working space in Vancouver. I'm up here for a couple of days with my wife, and I just scrambled to find a place to get this recording in, but wanted to spend some time talking about real estate today with my co-host here. So this is your first time to the show. This is the show that teaches you to make massive income, not just passive income with your real estate business. I am your host, Mike DeHaan, here with my co-host, Dylan Cook and Dan Austin. And on these midweek shows, we talk about real estate investing, business, and whatever else we feel like for the week. So one of the things that we wanted to start with this week on the investing realm was this chart that you sent over, Dylan, specifically around multifamily and kind of the delinquency rate that we're seeing with these. And I think it's a good conversation to start with because it's something that, I would say it's like been on the horizon for a while, but some of these multifamily properties that were getting bought at crazy low cap rates over the previous number of years, and now they're all starting to get taken back by the bank. And I remember way back when Dan and I started the show, we would kind of talk about this a lot, but it was always treated as like, we don't really know what we're talking about.
You guys are stupid.
We're just the dumb single family guys where they're all printing money by increasing their NOI and with the low cap rates and everything else. But give us your take on this, Dylan, since you're Mr. Economy, and kind of why you think this all broke down.
Well, for the listeners too, like if you look at, this is from Bravo's research, and they pulled it directly from Bloomberg Finance, and it's from 2004 all the way to basically the May of this year. And the attention grabber here is like the Freddie Mac delinquency rates for multifamily housing is now like past what it was in the 2008, 2009 like financial crisis, right?
Mm-hmm.
And so when people see that, they're like, we certainly don't feel that in today's economy. How can that be? And I think what a lot of people don't realize is there's a lag effect, especially to some of the stuff that happened over the past couple of years, and moving from 3-4% interest rates to now 7-8%. And anyone who's on a bridge loan, it takes a long time for that stuff to play out, right? If they have reserves, if they have other assets, if they're doing a capital call, there are a lot of things people can do to stay solvent for extended periods of time. But eventually, the chickens come home to roost. I think that's what we're starting to see.
Yeah. I mean, and I think there's a couple of reasons that this happened, right? But the big thing is people were buying stuff at lower cap rates than they had before because interest rates were so low. And they were making assumptions about how rents were going to continue to increase, even though we're facing an affordability crisis. And one of the big things that people were getting caught is a lot of these loans, they're adjustable rate, right? And so you end up in these situations where you're expecting interest rates to stay the same 3 years after you buy them, because they'll do these 3 adjustable loans, and sure enough, they now jump to 7%. And now you're just hemorrhaging money on this property and you can't refinance it or anything else because you no longer have any equity.
I don't think that's even the reason. I think that's like a reason, or like the output of a bunch of bad decisions, because cap rate, like ceilings have always existed. They've always been there. People have been buying multifamily forever. I think personally, because I'm looking at this graph, and like about 2 years after the financial collapse is when the delinquency rate really started picking up, which to your point, Dylan, there's a delay effect, but there's no real immediate recession. You got the 2020 so-called recession, and maybe this is things shaking out of what should have been a longer, deeper recession that wasn't, because the Fed printed a shit ton of money. I don't know. I just feel like there was something more cultural or something larger, like social movement, because I know when we all joined Go Abundance, if you would have like thrown a rock, you would have hit a syndicator, and they all seemed to have the same persona. And that was, they couldn't understand how to make residential, like typical fix and flip, buy a duplex, buy a single family. They couldn't figure out how to make that work. They generally speaking had a wealthy family member or were in a high W-2 job that for some reason they wanted to run away from, even though they were making $300,000-$400,000 a year, working 12 hours a week.
It's funny
that was
because
the persona.
I know several people that have all of those things that you just said that used to be
Right.
GoBundance aren't anymore.
Yeah,
They were
and-
like,
and
you know, the wife's a
yeah.
dentist and they work at Netflix and their dad owned the largest real estate company in XYZ city.
Yeah, and it felt like though that there was like a social movement around that, right? It wasn't like there was any data showing that you should be doing that they should be doing that. And so then the deals that they were looking at, they were basically just they were leveraging close and near people in their circle for relationships to get that believed in them to sell them really crappy LP positions in deals. I mean, that's kind of what I felt.
Syndication, to your point, Dan, got super popular. It was a sexy thing to do, and that you could say you own, 4,000 units or whatever it was. But I saw some of these pitch decks, to people sending them to me, and even my own market, they'd be like a C-class neighborhood, and we think we're going to get, $1,500 for a 1-bedroom by year 5. I'm like, the fuck you are?
I know, right?
Like, there's just no way that makes any sense. And I think a large part of this is like they would underwrite to perfection, or even better for perfection, honestly. And like when those didn't happen, and you have rising cap rates at the tail end of that, it's just a recipe for disaster.
Right. Well, and you're a person that's reasonably sophisticated that understands because you are buying rental units, you are doing things. So they're selling these to people that have cash or some cash. And they're like, oh, yeah, you've talked about real estate a lot the last year. You seem like an expert. Let me invest my 401k, this self-directed IRA that I now have. Let me invest that.
Or they'll help you do that. They'll help you do that.
Yeah, exactly.
Yeah. Which is such a red flag, by the way. Anytime someone offers to help you get more liquid so that you can give them your money. Don't do that. Yeah. Like that's like an old thing. I remember talking to people in the past that signed up for the sub 2 group, and I guess people said that Pace used like a third-party sales company, but like literally what they would do is they would coach people on how to get 0% interest credit cards so they could pay to join sub 2, and they're like, oh yeah, you'll just make it back when you get your first deal, so don't worry about it. And then sure enough, they don't do a deal because they're stupid. But back to the multifamily stuff, though, I imagine there must be a hell of a lot of people that had LP positions in a lot of these have just gotten wrecked.
Yeah, I mean, like I shared with you guys prior to this, there was an old guy in GoBundance who I knew was an LP, and I think it was 5 or 6 deals, $50,000 a pop, and he saw 0 returns. Like he lost all of that money.
Was that all of his LP positions too?
Yes. Yep.
It's so crazy.
That's crazy.
I mean, you think about it, like for some people, that's probably all they have, and they were fully bought into real estate as an asset, but they were busy with their jobs or different things, and they didn't want to start their business themselves. So they trusted somebody else and have to go all to 0 like that. I mean, that's the biggest knock on being a completely passive investor, because if you're investing yourself and you're buying like a duplex, sure, your return might be shittier, you might lose money, but it's probably not going to go to 0. Like, honestly.
It'd be hard. Yeah.
It'd be hard.
And you always have the ability to hold on to it indefinitely if you really are worried about that.
And I don't think any of these GPs were malintent. I just don't think they had the experience, and it's been so good for so long that they got caught up with everything. And I think they were probably genuine, and they thought they were going to get the returns that they did. They just didn't have the wherewithal to know what was going to happen.
Have you guys heard of any like legit syndicators that have had trouble with deals where they're losing people's money?
Brandon Turner.
Is he like losing?
He was about to. He had to do a massive raise to pay off that loan for that Austin property. That was all over social media.
Or something.
Yeah, I think there's another Houston one. I don't. There's another scale member who's an LP in it. I don't think he's allowed to say much. Right now, but it's not going
He's made a YouTube video about it.
Yeah. So I would caveat that with I would not consider Brandon Turner a legit syndicator operator. I'm not saying he's a bad one. I'm talking about the rich dudes that you've never heard of because they have like 10 billion under management, stuff.
Oh no. Well, I think the thing is with some of those guys, you look like a Grant Cardone, for example, like Tim McElroy. You get so big that you could just bail yourself out if you need to.
Yeah. Well, sure.
Right? Like it's like how we are, like with our stuff down, we have stuff go sideways. Like we still have this flipping duplex in New Orleans that have a sub 2
We're not
called,
flipping it. It's a flipping duplex.
Yeah, that got the sub 2 got called earlier this year, and now a year later we still have this one, so we couldn't sell this one, but we were able to get ourselves out of it because we just had the money to pay it off. Right? Like if Grant Cardone is about to lose $10 million of investor money, might let it go, but he knows that would destroy his reputation. So he probably just pays it off or just raises it again and then uses that money to pay off all the first people.
Or do something not illegal, but something structured the right way to make it work.
Right.
Yeah.
And there's something to be said for, like, if you, I don't know what it is, but it's like if you owe the bank $1 million, it's your problem. If you owe the bank $100 million, it's the bank's problem. Like, the bigger you are, they are more likely to work with you. But if you're a small and pop guy, they're like, we're taking this property to foreclosure, get fucked. Like, you're gonna lose it.
Exactly.
Like,
Exactly. And some of them are crazy too. Like there's a lot of the multifamily ones, but even some of like the mixed commercial ones. Like I've seen a couple of people on Instagram post some of these ones in like downtown Austin that like were bought a couple years ago for like $100+ million that are now like have gone to auction for like 20-30 million bucks. Right. Just like
the drawdowns are insane.
Yeah. Because they're empty. Like there's no one in them. And so they're not really worth anything.
I think one thing too, if you are an investor the past couple of years, and let's say you have an interest in buy and hold or small multifamilies or even larger ones, and you are getting beat out by these other syndicators, and you're like, how the hell are they paying that much money? Who knows? Maybe the next, 6 months to a year, next couple of years is your time to shine because you were actually stuck to your guns. You didn't overbuy stuff, and your underwriting will now actually prove fruitful, and you have more opportunities.
Exactly. Yeah, I think there's tons there, and stick to your own numbers too. Like, don't look at what other people are buying and like think that they all know what they're doing and making good ideas. People can make dumb decisions. Just like in 22 when the market turned over, there were so many people that we saw in 21, Dan, that were buying these super, super tight flips. And it was so tempting to want to compete with them. And like, well, they're just putting it on the market and it's selling in 3 days and they're making 30 grand. Like, why don't we do that? And then sure enough, they had 15 of those in 22, and then they ended up losing millions of dollars. But same thing happens to the multifamily. Exactly. So don't get FOMO and stick to your own numbers, but it's always a fine line because also if you just sit there and you're too cautious, you'll never do anything.
That's the beautiful thing about investing, man, because I'm sure if we all had time machines, we'd been like, we should have been more aggressive, during this span. But then we don't know when to stop, or like if you have a super long rehab, like that's the other thing with commercial too. Like it just takes so long for these to develop. You just don't know.
Yeah.
If you don't have interest rate caps, like a lot of those loans have interest rate caps. So like they went from 3% to 8-9%, right? Like, but some of them, maybe the better operators knew to look out for that. They're like, okay, well, the maximum interest rate can go is 6%, and so they can underwrite for that.
Yeah. And when it comes to LPs too, if you have a limited partner, it's just important to understand the person and their track record and to be super hesitant if it's somebody that either isn't super financially sound themselves or doesn't have a great track record, because people tend to do shady things when they don't know they're doing shady things or when they have their back up against the wall and they kind of need to. Because Dan and I both have, do you have just one LP, Dan, or do you have two?
Just one. I don't trust enough people to do more than one right now.
See, so I did a second one this year, but they're like, the rare people that I've met that get really good vibe from them. I've gotten to know them. I like the deal. I like what they're doing. And I'll also say too, both the ones that I've done, they're not like these value add multifamily deals where they're kind of speculating what the area is going to look like. The one that Dan and I both did together, it's like a new build in this area that has a massive demand for new build properties with a guy that this is what he does. He's like a pro with it. And the second one I just did was part of a massive like self-storage roll up. And the guy that's doing that, he literally liquidated his entire residential portfolio and it was like 8 or 9 million of his own money into the deal. And it's like a $40 million purchase. So like he's into it himself, like almost 20%.
He's all into it. He's a good person. It's the person that matters more than anything. Totally. Are they trustworthy? And do you have a track record with them? And I mean, the funny thing about the new build one we're in is, I think is somewhat coincidence, but like when I was at the recent GoBundance event, they had one of the big hedge fund operators there talking about, we don't do value add. Like that's stupid. We do new build only. And here's why, because when times get tough or when you're going to get valuation, you're going to get higher rents in a new build. When there's a 400 unit new build across the street from a 400 unit value add, the numbers pencil out much better on the new build, because by the time you're done with the value add on the used one, that you basically have to start over. And my new one already still looks better because it's it's new, right? So it takes the same time to build one as it does to value add one. Anyways, with the one we're in, it's new build, and it's just by happenstance that happens to be a good performing deal. I guess a coincidence that that's the one we picked, but it was based on the operator that had the experience and is trustworthy. And it wasn't something that was way out of his, I would say, way over his skis or out of his typical deal.
So he wasn't a physician that decided to pursue new
ground of software developer that was going to be a syndicator. Yes, this was his craft. He had already scaled and sold a business. He ran a construction company, ran a property management company, and had been doing redevelopment deals. And this was sort of a redevelopment deal, but with a new build component.
Yeah, and also not once did he say that the bulk of the return is in the tax benefits, which is just a great way of saying I'm trying to sell you a shitty deal.
Yeah, you really technically get $100,000 in tax benefits.
Yeah,
so it makes it $100,000 profit.
Exactly. Yeah. So if you add that into your cash on cash, it's now at 4.2%.
Yeah, exactly.
God damn it.
Yeah.
Anyways, but all right. Yeah. Anything else to add on that? I think it'll be an interesting thing to see, but I think a good takeaway, Dylan, like you said, is if you're looking to get into that space, start, reaching out to bankers and watching the auction, because you could start to get some very legitimate multifamily deals for some good discounts right now.
Yeah. Totally. And if you have relationships with lenders, like I have a couple here locally, just maybe call up them and say, hey, if you got anything bad loans on your books for this type of asset, give me a call, because they don't want to own the property. They don't want to take it to foreclosure. You come in and save the day and get a good deal. It's a win for everybody.
Yeah. Yep. Yeah. So it's good connections to have. Awesome. So
next thing, if you don't,
go for it.
We'll just go into it. Really, it comes down to like where most major institutions see home prices. And I know, Mike, you have a opinion on maybe a conflict of interest here, but the one is specifically from like the big names: Bank of America, Fannie and Freddie, Goldman Sachs, NAR, Wells Fargo, and basically all of them have the consensus that we will see positive house prices in 2025, ranging from Apollo Global Management at 10.8% year-over-year increase. And the only one that's negative out of like the 10 listed here is Moody's, which is a minus 0.4%. So basically flat. So the general consensus here is like everyone thinks that we're going to have positive appreciation through 2025 of next year. And that's a good contrast to last week when we mentioned how basically the broker was like, I expect significant price declines through the middle of next year.
Yeah. So my big challenge with this one that you put together, I guess you found this somewhere, is that all of the companies listed are all businesses that give out mortgages, right? Bank of America, Fannie Mae. I'm assuming Goldman Sachs has something in mortgage that it gets involved in. I mean, Housing Wire is a real estate housing company. The Mortgage Bankers Association, National Association of Realtors, Wells Fargo, Zillow, like they are all financially incentivized for people to continue getting mortgages and for properties to go up, which if they go and they say that, hey, we think property is going to drop 10% in value next year, people are going to stop buying real estate. Right. Mm-hmm. And that's always whenever I see stuff like this, I always look at where exactly the message is coming from before I put any faith in it. Like I would put more belief in what we talked about last week with that. Was that like a hedge fund analyst?
Right. Yeah, she's kind of like an independent consultant where she doesn't really like, it doesn't matter if it goes up or down. This is mainly research.
One also too, like just look around and, give everything the bullshit test, right? Like people generally can't afford stuff. The general view is that interest rates are going to stay the same and keep climbing. Mm-hmm. The 10-year yield, which you were looking at earlier this week, has gone up over the past month, which is what mortgage rates are based off of. So I don't really see real estate going up next year unless all of a sudden people have more money, which they're not going to.
Would you have guessed it was going to go up this year?
In 24?
Yeah.
No.
Yeah, because it went up this year, right?
Has it gone up this year?
Mm. Yeah, the median house price nationally is up. Yeah. It's marginal. I don't know what it is, but it's marginal. It's probably
number of sales is lower, but the median price is a little bit higher.
Is it how much higher is it like nationally?
I'd have to look it up, man. But it's just a couple percentage points.
Maybe a little bit, right? Yeah. See, but here's the thing though that's interesting about that is I want to see how that's broken down by area, because I know, for example, Spokane has gone down. Right.
I'll fact check you while we're live. Keep talking. I'll fact check.
I mean, I know because I track the value of my own properties. Some of my own properties have gone down in value.
Well, yeah,
right? A lot of the major metros have seen declines in value, especially the ones that really exploded in 21 and 22. But if you're going to some of like the Midwestern markets where people have been moving because you can now buy a 5-bed, 3-bath home for $200,000, which is affordable for people and people who can work remote, or even places like some of the Midwestern mid-sized cities like where you're at, Dillon, Cincinnati, and Cleveland, you're starting to have more and more people moving there for the large companies that are based out of there. Those things will pull up like the national average, right? That's the other thing too, which I hate with stats like that, is that it assumes that the entire United States is like going to go the same direction, when realistically the U.S. is a bunch of different countries that have their own micro economies.
It's honestly, that's my same opinion when it comes to inflation. When like people are like, oh, we had a 2% year-over-year inflation. I'm like, it totally depends on the area you live in too.
Absolutely.
Like, because housing is a big driver of that for one, but two, like this transportation, gas, like whatever it may be is different for another. Or I don't know. It's just like I'm a pet peeve of mine. And I think you're totally right. If you have like Columbus, for example, which is not Cincinnati, but just up the road, they have an Intel factory or campus being built. Right. So how many new jobs are being developed right then and there? Like no matter what happens, like they're going to have a positive appreciation in the real estate market.
It's hyper local, and you got to know you can't talk to people in one state, one city for the next, right? Because it could change. Spokane house price, according to Redfin, is up 4.4%. I don't know how. It doesn't feel right.
Exactly. You don't know how, but I would say that is not true. Like if you go,
do you think that they're just like, what do you think would drive that?
I want to know where they're getting that data
because
from.
If you think about it like this, like again, this is a good point, because like your houses that you might be selling are in like a nicer area of town. They're not like premium properties, right? They're good first time home buyers, step up type houses, right? But the lower end stock, which is the vast majority of Spokane, maybe it did go up a little bit. You know what I mean? And that could swing the number.
I don't know, dude. Even looking at the wholesale stuff that we're doing, like you can look at
houses
and we can look at them and say, oh, dude, like 3 years ago, we could have sold this. The ARV on this thing would have been 350. Now it's maybe like 300, 310, maybe. So I don't know how they got that data.
Compare it to 2022. For sure, you're going to notice a big difference because it just felt like things were so much higher. But I guess here, according to Zillow, 0.8% past year, median sale price $433. So, I mean, and these are month to date or month to month. So it could be like shifting 12 months is different than the actual year to date 12 months.
That's actually valid. So like it like bottomed out like last November.
From like October to October, it's going to be higher. But if you actually looked at like year to date, like it's lower.
Yeah, that's what you're saying. Yeah, I don't know. I think that fundamentally one of the big things is just nobody knows. That's why it's important to be finding good deals and marketing for your own opportunities, and sticking to your numbers and not over leveraging yourself just in case stuff gets weird.
I don't know how flippers who don't source their own stuff make it. Like, to be honest, like
I don't know. Like we have some buyers that source nothing themselves, and they seem to do all right.
Yeah, I'll say this: not all the flippers, the flippers that I know that have historically just the last 12 to 24 months been trying to do more and more and more are peeling back and saying, I need to do less. But then there's these onesie twosie guys that they just pop off deals 2 or 3, 4 a year, and they're happy to be buying. Those are the ones that like, I just got a text from a guy now. He's like, hey, you got anything right now? He probably buys 3 or 4 deals a year. You know what I mean? Maybe 5.
Yeah, I think like the flippers that don't source themselves, Dylan, what they're really good at is knowing their numbers and saying no.
Yeah,
right? Because especially if they have a brand like or connections where they get opportunities all the time, it's very easy for them to say no. And because we only see a certain percentage of deals in each of our respective markets, right? And so even though they say no to your deals constantly, there's other deals that they buy, otherwise they wouldn't be around, they wouldn't be in business, that they like better.
Some sellers, especially have a very negative connotation around any kind of investing or investor, right? They're like, I'm not selling it to an investor, and they'll go to a realtor, and the realtor will sell it to an investor, but they just went to a realtor first. Yeah, so that could still happen off market.
$5K.
Yeah, and they'll make their commission or whatever, but there's a trust aspect to that too, which can intertwine with you having a brand and a website and all this kind of stuff. If you just have this postcard that says, I'll buy your house cash, and they Google your company name and nothing pops out, that's probably a red flag to most people.
Totally. Yeah. So, yeah, I mean, make sure you have multiple exit strategies on stuff too. Like,
Yeah.
if your only exit strategy is that you're gonna have to do a super lean flip and everything's gonna have to line up right away, not the time to be making purchases like that.
Yeah.
So let me ask you this, because there's some places that come up now that I'm like, okay, if this doesn't sell, I could rent it. But even on the rent side, like I'd probably be losing a couple $100s a month in cash flow. Like,
don't do it. Like,
what would be the situation like for you personally if you were to lose 200? Like, is it like, hey, I can hold on to $50,000 in equity and then maybe lose $200? Like,
so that would be very location dependent, right? If it's in a good area of town where I'm thinking, okay, I'm good. If I hold this for 5 years, I'd probably do it. If it's in a C-class area or worse, I'd probably want it. Or do you just wait for better opportunities or take it down and throw it on the MLS and see what happens? Like,
I think
those are like the risk rewards you have to take.
Yeah. And I think given specific circumstances, if there's like 50,000 in equity and you can like just get that after sales cost, maybe it's 30. So it's a $30,000 flip, or you hold on to it and go negative a few $1,000s a year. Like, I would take the equity now. However, if that's your flip and your alternative is to lose a couple $100, but you'll make it up over time, that's fine. You just can't do that all the time.
Yeah, totally. And so if you're a newer investor, that strategy is probably not very viable.
No, but not great.
Yeah, not great. But if you're, someone's been doing this a couple of years, or your current portfolio can kind of subsidize some of that, then that could be an
throw
option.
Throw it into your portfolio and let it, if you really like it and you're bullish on it and you want to keep that house or that property in that market, hell yeah.
Yeah. Well, and then just be realistic on like the long-term upside with it, because there's the expenses will pop up, they will change, rents are always going to be hit or miss. You're going to have vacancies. So like my personal portfolio of 10 units that I own outside of Dan, I'm going to be essentially break even on the entire year, right? Because I had to turn 1.5 units over the course of the year. I had a couple months of vacancy in a couple different units. I just had a very unexpected vacancy where the person had stopped paying for November and actually cashed for keys to tenants and told them just to get out by the weekend, and then I wouldn't take them to court. And it worked. So all in all, like I think total net, I'm going to make like $500.
Hey, dude, that's positive. It's better than negative.
It's true, but like, then you look at the equity that I have in that, and it's like, what's the point?
Yeah,
honestly,
the opportunity cost. Exactly. I don't remember if you mentioned this last time we talked. Have you gone back and looked at every year, like what your cash flow has been, and is this year an anomaly, or is it like underperforming cash flow wise from what you would have hoped?
It's been trending down since 21.
Really?
Because what keeps getting me is the increase in insurance and property taxes.
Yeah.
Right.
Just eats away at it, dude. It's been nuts.
Yeah. And rents have slowly started to fall as well. Right. Just like in some of these places where they were so high. I mean, like there's units that I had rented previously for $1,700. To be fair, when I rented for $1,700, I was like, that's insane. I can't believe someone's paying that. But now I'm renting them for $1,500. Right. But at the same time, my property taxes have increased on that property $600 a month.
Yep.
And so those things kind of merge together and the cash flow just disappears.
It kind of sucks too locally. I know everybody nationally is getting beat up on taxes, but in particular in Spokane where we live, we started buying, like Mike and I, like rental properties and stuff right after or right before they implemented a new system here in Spokane for calculating your property taxes, and it'll do it much quicker, where before they just wouldn't change for years.
I know.
They didn't have they literally couldn't assess it. They would have to wait till they assessed it. Every time they assessed it, they'd have to go around and assess everything. Now they have a software that does it, and it does it rapidly, and it's kind of accurate, which pisses me off.
It does.
Have you ever contested your property tax value?
I haven't.
It's
I wanted
really
to before,
challenging. Yeah. So, but the risk you hold, though, honestly, especially if in some of these units, with how they have like finished basements and things like that, I run the risk of it going up, right? If they go in,
because they don't include that.
So I'll look at like the recorded square footage and I'll decide if I think it's similar or not. And if it's like a little bit low, I'm like, I better not say anything, because they're going to go and they're definitely going to increase my taxes.
So here locally, like they reassess every 3 years in Hamilton County, but if you bought a property for 300,000, like you're not going to win that case. Like you bought it for 300,000, the assessed value is 300,000. But if you do like the tricky stuff, not tricky stuff, but some of the more advanced stuff where you buy it through an LLC or something where you really can't see the purchase price, and you try to assess it, if you come in with some valid comps and like an appraisal, I've had success with getting reduced, property values before.
Yeah.
Here's one thing this is interesting. I know, Mike, you got this email from our property manager. So in Washington State, they have a new law. I don't know my opinion on this yet, but I was thinking about this in the context of this conversation, is if you want to do a rent increase above 3%, you have to give the tenants a 6-month notice.
Isn't that crazy?
Wow. That is wild.
And so how does that, because they still only have to give you 20-day move out notice. So you could say, hey, I'm raising your rent by 3%. And then 20 days before the lease is up, they tell you, sorry, I'm not going to stick around. So it's kind of tough.
Yeah. I think honestly what would make sense to start doing is you just bake it into the lease when they sign that they will be getting a 5 or 6% increase every year.
Yeah. If you can do that,
that's what a lot of commercial leases are. I wouldn't see why that you couldn't do the same.
Yeah. I mean, then it avoids any timeline stuff. And then if there's any battles, when you signed the lease, this was in there.
What we typically do is do an annual lease, and then it has like a month-to-month clause
that increases,
in there. But it goes, if you go month to month, this will be your new rent. So
it's kind of tricky thing. Washington has a tougher law around month to month when it comes to move out. Then you have to give them 120-day move out notice if it goes month to month, and so it's tricky. You don't really want it, and then your eviction it's tougher after month to month. So we have to be walking a fine line. You have to just
we don't have those problems here in the Midwest.
Yeah, you have to be wired tight on our stuff. The interesting is the next line down is if you have Section 8, you just got to give a 30-day notice to raise rent. And I'm like, the most low-income population, and they just get a 30-day notice because they're not paying a portion. Well, some of them have to pay a portion of it.
Yeah, sure.
And 3 to 5% might be a big deal to them. Maybe it's $20. That's, I don't know. That's food for the afternoon or the evening or something.
Totally. Yeah. It's been interesting to see how that sort of pans out across the country as different things happen.
Well, anytime that there's an economic hardships, right, then the government wants to come in and protect those people that are in a bad spot financially, and that creates more costs on the landlord and the owner of the properties, which in the interim is great for the little guy, but then as time goes, it gets harder for people to actually want to rent and lease out properties.
It does.
Because the cost is you're finding, Mike, the cost becomes excessive to where you're I'm not getting a return. I have to go to a different asset class that's not real estate.
Totally. Or you have to sell it, and for some, it's funny, some people think it's good because it'll go back to homeowners, but when it's some of these funny duplexes and triplexes and stuff, I'm no, those are,
it goes to a shitty
properties.
Person that doesn't know how to be a landlord, and then they're assholes to these people.
And then
they're
we end up full
purposely
cycle
built multifamily stuff. Not a chopped up 2,000 square foot house.
And then it goes full cycle. In 10, 20 years, all those people are selling their proproperties to their back wholesalers just like us because they didn't maintain them.
At a
and
discount.
We're
excited to buy them.
Bad tenants. Exactly. Cool. Awesome, guys. Well, we'll wrap up there. Right on, guys. Well, appreciate you all listening. And I appreciate you all that responded to me on Instagram yesterday. I put a little post. I'm at Mike_invest, just asking for some feedback on directions on the show. And quite a few people, they said that they wanted to hear more specifics around deals that we do, we are specifically doing within our business. And so we're going to be changing up the Friday episodes a little bit here, where each week it's either going to be myself, Dan, or Dylan, and we're going to talk about a recent deal that we have done. And I'm going to be doing the first one here this Friday, talking about a little 4-package deal that we did with the same seller, but that we had multiple different buyers on. So it was a pretty interesting one to sort of walk through. And so we changed that around for the Fridays for a little bit. If you like that idea, hate that idea, you like those shows after you hear them, please let me know. All feedback is good, whether it's good, bad, or in between. So you can just shoot me a DM on Instagram, Mike_invest. I'd appreciate that. And then you can follow Dylan at Dylan_does_deals. You can follow Dan at InvestorManDan. So right on. Thanks for listening, everybody. We'll talk to you guys next week.
See ya.